Morning everyone. I think you should all be able to hear me now. Sorry that we're a minute late, just getting a few little gremlins sorted out. I'm just going to share my screen and then we'll get the presentation underway. Super. Well, just hide Az's face. Right. Good morning, first of all. Thank you for joining EIC's Energy Procurement Webinar Series. This is the first of three titled Commodity Costs. Just some quick housekeeping first. Session's planned for 60 minutes. Should last about 45-50 minutes on the presentation, and then there's some time at the end for any questions. All the microphones are muted and all the cameras are turned off. There is a Q&A function available. If your Teams looks like mine does, then you should see a Q&A at the top on the navigation bar there. More questions we have, the better. So please do ask questions throughout the presentation. If we can answer a question straight away, and it makes sense to do so because it fits with the flow of the presentation and it isn't covered in later slides, then we'll answer it straight away. Otherwise, we'll answer them at the end. If we don't have an answer straight away or we run out of time, we'll come back to you directly after the session. The session is being recorded and the video will be made available to everyone. So first of all, just a quick disclaimer. So, like I'm sure everyone knows already, the energy markets are volatile. And they're influenced by lots of factors, so lots of them outside of our control. So there are no guarantees within the presentation like you'd expect. The only thing that we can guarantee is that no one knows for certain what is going to happen next. But that's the reason why organisations like EIC are here, to help people to navigate that risk and to get best value. So EIC are in the 50th year of successfully supporting organisations with energy-related challenges like buying from a volatile energy market. So although there aren't any guarantees, we've got a lot of experience and a lot of expertise in the area. So now that's done, we'll just do some quick introductions before I hand over to Ramnik to deliver the presentation that he kindly prepared for us. So firstly, myself. So my name's William. I know from the attendee list that some people I know already and know me, but for those that don't, I'm part of the sales team at EIC. I joined in 2010, so I've been here for 14 years. I've worked in the account management team and the sales team and had the pleasure of working with lots of different organisations, public sector, private sector, with lots of different requirements over lots of different market environments. So I've been speaking about this kind of thing for a long while and I still enjoy it, so that's a good thing. Ramnik, would you like to introduce yourself?
Yep. So hi everybody, I'm Ramnik Singh. I'm an energy trader at EIC Partnership. I've been in the energy sector for the last 14 years, 11 years at Centric Energy in various hedging, trading, optimization roles, and the last 3 years I've been with a broker, with brokers. My main job role is basically to watch the market, navigate the market, and help customers achieve lower unit rates.
Super, thank you. So EIC, I've touched a little bit on it already, but yeah, it's an energy consultancy with a long history and a good track record of supporting organisations with energy-related matters. The root of EIC's existence, some nearly 50 years ago, was based with market intelligence and looking at the commodity market. So, although it's 50 years ago, as long before I was born, and things have changed an awful lot since its inception. Market intelligence is still a core offering that we have, and it's still the cornerstone of our procurement solutions. The solutions that we do offer have evolved over time to meet customer demand, greater legislative pressures and demands for more sustainable solutions. So the offering has developed, but what always has remained and is probably as important now as it ever has been is the market intelligence and the energy procurement solutions to help organizations to mitigate price risk and to get best value. So this session is exclusively about the commodity market. It's not about any of these other challenges. So we'll skip to the next bit. So there's just a couple of charts there just to demonstrate why we're talking about it first, really. So the first reason that we're talking about it first is that it affects everyone the same way. So whether you're a private sector organization, a public sector organization, a fixed procurement, user, or flexible, if you have flexible supply contracts, or you're part of a consortium, whatever you do, if you're important from the grid, you're exposed to the same market as everyone else who's important from the grid when they want to hedge. So that's why it's important. It matters to everybody the same. The commodity costs, like you can see here, are very significant and can be very volatile. So for those who haven't seen it before, this chart here just shows over the last 5 years and the forward 5 years, a bit of a projection of what the makeup of your overall electricity costs are going to be like. So the commodity element is the block at the bottom. And over here, we can actually see how volatile it's been over the last 3 years or so. So they are very volatile and the cost can be significant. And the third reason, and the most important one, the reason why it's worth talking about, is it's the cost element that you can have the most control over. So the choices that you make about how you buy your energy, the commodity, will have the biggest impact on your costs. So that's the reason why we're talking about it first. So I won't say anything more about it. I'll hand over to Ramnik now. I'll still retain control of the slide deck. So Ramnik, if you just shout out when you want me to go to the next slide, I'll do that for you.
Sure, no worries, William. All good. So guys, so this presentation that I've created is going to be based on three main things. I'm just going to look into what's actually happened to commodity prices over the last 3 or 4 years, why it's actually been so volatile. I'm going to look a little bit into what's actually happening right now, so the current market fundamentals, look at some of the supply and demand factors that are influencing the market, as well as some of the geopolitical risks. And then lastly, I'm going to look into what can we expect going forward, the kind of risk factors that are still evident in the market and that can impact the prices going forward. So the chart on the screen right now is basically the UK gas price on the day ahead for the last 22 years. As you can see, over the last, so from February 2022 to February 2020, prices were pretty much range bound and below 100 pence per therm. We had the odd event that created some sort of volatility. As we can see, in 2006, there was a fire at the Rough storage facility. And again, in 2018, it was a weather-related event called the Beast from the East, which basically made the market spike, but then it quickly returned to equilibrium. So from an I&C perspective or energy management perspective, bills were there or thereabouts, give or take 2 or 5% year on year. You were pretty much seeing the same cost year on year. What actually happened thereafter, or towards 2021, was there was a structural shift in the market. So what do I mean by structural shift in the market? The consensus has mainly been that, the prices have gone extremely volatile or extremely high because of the Russian invasion of Ukraine. But the reality of it is the Russian invasion of Ukraine happened in February 2022, but you can see the spikiness in prices even before that. So the reason why that has happened was the UK government in 2018 decided to decommission the Rough storage facility. So the Rough storage facility held 13 days worth of winter gas supply. So if you think about it, if you take away 13 days worth of winter gas supply and you don't replace that with anything, the markets are going to become a little bit more volatile. So as a trader, we knew that this was going to happen going forward, but as market participants, that sort of knowledge wasn't out there. And the reason for that was in 2019, we had a warm winter. Again, there was no real demand, prices stayed low. In 2020, it was COVID. Again, no real demand, prices stayed there or thereabouts. The real shift in pricing started to happen in 2021 because we started to see cold weather during the summer period, and markets became a little bit more anxious about how prices would develop thereafter. So that was the first shift, and then obviously thereafter there was in the Ukraine and a few other things I'm going to allude into. Also, just something to note, the market structures change given in different periods. Like for example, if you look at it from markets from 2013 to 2020, markets were largely, or UK gas prices were correlated with oil prices. That correlation has now pretty much doesn't exist. So now markets are more, or UK gas prices are more influenced by what's happening in Europe and Asian gas prices. So historically, it was oil prices. Now it's more prices to do within Europe and Asian. So different market conditions dictate different market prices. So, and as the market matures, different factors come into in play. Sorry, moving on to the next slide. So just going to quickly go through some of the factors that actually impact the commodity cost on your bill. Just trying to make sure that everybody in the audience is aware of the kind of things that could impact the UK gas price. So UK gas and power prices historically were determined, like I said, by oil prices and supply and demand fundamentals within the UK. It wasn't that well connected to Europe, and it wasn't obviously connected to the rest of the globe as it is now because of LNG. So markets were largely determined by supply and demand fundamentals within the UK. Now, a weather event in Asia or an LNG worker strike in Australia does have an impact on the price. So the market has become a little bit more interconnected, and various factors or geopolitical risks that did not influence markets before are starting to impact markets right now. So in general, your commodity costs are now prone to more volatility and are more exposed to geopolitical as well as weather events in other parts of the globe. So just going to quickly touch upon this. So your commodity costs are touched or are impacted by supply and demand fundamentals in the UK and Europe. So Norwegian Supply, which is a large or vital provider of UK gas supply. So they normally import, so the UK normally imports around, I'd say 30% or 40% of its consumption from Norway. So the UK's reliance on LNG, which is shipped fuel, which goes around the globe to the highest payer. The UK obviously relies on that now as well as part of its generation mix. Storage plays an important role, even though that the Rough storage facility was decommissioned because the UK government wanted to go towards a more greener economy. It basically decided to decommission it and wanted to replace it with a hydrogen facility. But what actually happened was after the Russian invasion of Ukraine, the government pressure was so vast that they decided to reopen it. And now instead of having 13 days worth of gas supply, it's got 3 or 4 days worth of gas supply. So it's been reopened since, because there's obviously a fine line between energy security and obviously the climate goals in itself. So demand destruction, price economics continue to play a key role. So even though the UK might have gas within its borders or within its destination, but the reality of it is, if Europe's got a higher price, and because pipelines are private, the UK does send gas towards its European counterparts so that it can make money. And then obviously the weather is a big impact. And we've seen what's happened over the last 2 years when prices have pretty much fallen or have been on a downward trend. And that's only been because of the fact that we've had 2 warm winters in a row. Government policies are also impact prices. Like I mentioned, the decommissioning of the Russian storage facility, European storage mandates now are providing market prices with a little bit more lack of concern, because the reality of it is, because the Europeans are saying that storage sites need to be 90% full by the 1st of November, that's giving the market a little bit more reassurance that, look, we can go through winters without Russian gas supply. And demand destruction policies. Geopolitical events, which I'm going to allude to in the next few slides, is obviously the Russian invasion of Ukraine and the tensions in the Middle East and its impact on LNG trading routes. Also speculative trading, because the MVP is a liquid market, it's easy to come in and out of positions. Hedge funds use this market to also take positions, and all the players on the market are not physical users. A lot of them will be just taking positions in order to try and extract value from the curve. Okay, moving on to the next slide, please. So just going to look a little bit into prices before the Russian invasion of Ukraine. As you can see, prices are pretty much range bound and in line with stable demand and supply fundamentals. The structural shift happened, as I mentioned, and that was obviously because of the decommissioning of the Suez Canal. sorry, the decommissioning of the Rough storage facility, but there was also a Suez Canal issue that happened where a ship was stuck for 6 days, and because of that, a lot of the LNG couldn't get to the UK and European market, and that led my prices to rise. So the first sort of price increase was from April 21 to August 2021, was because of the Suez Canal and because of the fact that there was a cold snap. By that I mean temperatures were below seasonal normal. Storage sites are usually refill during the winter period, sorry, the summer period. And because of the cold weather, the storage sites weren't actually able to refill, and the market actually started to become really concerned about the upcoming winter because of the fact that rough storage was no longer available. And the reality or the concern was, look, without rough storage or gas in rough storage, how are we going to cope in the winter period? And as you can see, prices reached £300 and 300 pence per therm, even before the Russian invasion of Ukraine. So that's something I just want to highlight, that the shift in the market, or the volatility in the market, was there before the Russian invasion of Ukraine, and that was also part.
Rami,
Yes.
can you someone just asked what the what LNG was, just to make sure everyone knows what it is.
So it's liquefied natural gas. It's basically gas that goes around in containers. The main producers of this gas are Qatar, the US, and Australia. It's basically gas that gets shipped around to the highest payer. A lot of the UK, European, and Asian countries are starting to develop facilities which can accommodate this gas. So this gas gets shipped across the globe to the highest payer, and they all compete for it.
Thank you.
Sorry, and then obviously the Russians stopped sending gas towards Europe on the monthly auctions, or they were still following up contractual obligations, but the additional amount of volume stopped going through. And there was actually a concern at that point that, look, something is up with the Russians, and we could have there could be a stage where Russian gas doesn't come into Europe no more. And the market started to price all of that into the equation, and we can see the prices obviously exploded. Can you go to the next slide, please? So from June 22 onwards, we saw the Russian invasion of Ukraine, and we saw prices go as high as 700 quid per pound, £700 per megawatt hour, and 650 pence per therm. That was obviously because of the Russian invasion of Ukraine and the subsequent actions as well. So we saw the cessation of Nord Stream 1 gas towards the European market. We saw the sabotage on the Nord Stream 1 and the Nord Stream 2 pipelines. So all of those kind of things, and the concern at that point in time about the Russians wanting to get paid in rubles, and telegram messages saying that, oh, prices could go up to as high as 900 pounds per megawatt hour. So all of that kind of stuff was actually getting priced into markets, and because of that, we saw prices rise as high as 700 quid. But something else that was impacting the market at that same time was the French nuclear production issues. So what actually happened here was, because of warm weather or because of heat waves, a lot of the French nukes weren't able to operate. There was also reports of corrosion on some of the nuclear wells, and there was obviously reports of pipeline leaks, and that obviously caused great concern to the market because nuclear capacity was only operating at 40%, and because the UK and France is interconnected, that basically led to an effect, or a domino effect onto the UK market. So French power prices at that point in time had gone as high as €1,600 per megawatt hour, and the winter 22 contract at that point in time had gone to £850 per megawatt hour. So it just shows how connected the market is right now. Anything that happens negatively in France, in Belgium, in regards to power, or with gas in the Netherlands, impacts the market. So those heat waves and those French nuclear issues led to prices to reach record highs. However, the reports or the maintenance work that was carried out thereafter showed that the damage was not as bad to the leaks or to the reactors, and because of that, the market started to ease, and we saw obviously a big decline in the market leading into the winter 22 period. So during the winter 22 period, there's obviously great concern, like how is Europe, how is the UK going to get through the winter without Russian gas? And luckily for us, it was a warm winter, and because of that, less storage was used in Q4, and that basically meant the market was convinced that we could get through Q1 with enough gas. So warm winter, less gas used, which basically meant higher storage sites, and that led to the downward decline. There was a bit of a blip in December 2022 where we saw below season normal temperatures for 10 or 12 days, and that led the market to be extremely concerned about um, the supply outlook going forward. So I just wanted to reiterate one thing, that look, temperature still has a massive impact on prices going forward, even if we look into winter 24, winter 25. If we see cold weather this winter, it will have a significant impact on market prices, because the reality of it is, without Russian gas supply, we are out of a supply source. There's a gap in the UK European market, which has to be filled by LNG, which we have to compete with other people or other countries across the globe with. So there is a fundamental supply gap, and the market now relies heavily on storage, and it is very prone to any supply shock. So when I mean the market sensitivity to supply shocks, you can see what I mean here. From April 23 all the way to August 23, you can see the spike in April 23, you can see the spike in June 23, and you can see the spike in August 23. And all of those kind of things were impacted by, firstly, Norwegian maintenance. So Norwegian maintenance is very common in the summer period. Norwegian assets normally are at full throttle during the winter, and then when it comes to the summer, they go for maintenance. Normally, when assets go for maintenance, there are normally delays on when they return, and it normally never has an impact on the market price. However, in 2023, we started to see an impact of delays in Norwegian maintenance on market prices, which basically just showed how sensitive the market was to supply shocks. And it just basically highlighted that, look, anything that, if anything with supply trips, the market is going to basically react. We saw that with the Australian LNG worker strike also at the back end of August. Australian LNG doesn't come close to any UK ports or European ports because of the distance and the shipping costs. However, it goes to Asia, and if Asia doesn't get Australian LNG, it's going to take away the LNG that the UK and the Europeans normally get, which is going to lead to higher prices in the UK and European market. So overall, I'm just trying to just highlight the fact that, look, it's very interconnected. Anything that happens across the globe impacts the price on your bill. The Israeli-Palestinian conflict obviously provided the market with further volatility, which I'm going to touch upon a little bit later, as well as higher Asian demand, because a lot of the energy started to go towards Asia. LNG in Asia, because storage sites are pretty much non-existent across the whole of Asia. When it gets cold, Asia needs gas for heating. When it gets warm, Asia needs gas for air conditioning. And at that point in time, because of the lack of storage facilities, they are willing to pay a premium for the gas, and that's when the UK and European have to pay even a higher price in order for them to receive that sort of gas. So again, we're always competing with Asia now in terms of gas supply, and it's just basically been a shift. The European market has shifted away from Russian gas towards gas from LNG. Moving on to the next slide, please. So we started to see a downward price trend, as we saw in the previous graph. So I'm just talking a little bit about what's happening to prices right now. So prices right now are all below 100 pence per therm pretty much, and £100 per megawatt hour. What has led to the downward decline, and then during the first half of the year, and then the upward incline thereafter. So we got a warm winter again. So like I mentioned, winter 23, winter 24 were both warm, and because of that, less gas demand and less gas used in storage. And because of that, we saw a downward trend in the market. But more recently, we started to see a little bit more of the geopolitical tensions impact the market. So we saw some Russian and Ukrainian attacks on energy infrastructure assets, which led prices to rise. No damage was actually reported on any of the gas infrastructure on any of the gas infrastructure. So there was reports of Russian missiles attacking European underground storage facilities, but because the underground facilities are so deep into the ground, no damage is actually reported. So the market reacted when the drone strikes were reported, but when checks were done, nothing actually came off it. But the threat of Russian and Ukrainian drone strikes on energy infrastructure remains, and it continues to impact the market. So these are all, the upward trend is driven by geopolitical risks, and in both the UK and the Middle East. Obviously, the Middle East, the Israeli-Palestinian conflict is impacting the market through a different way. It's impacting the market because of the impact, or because of its effect on the LNG trading routes. The Red Sea route has basically ceased, and no gas is actually getting shipped through that route. And because of that, a lot of the gas is having to travel through the southern tip of Africa, through the Cape of Good Hope route. And because of that, LNG is basically becoming a more of an expensive fuel to procure in the UK European market. So the Middle East conflict is impacting LNG flows. It's not actually having a direct impact on any of the fundamentals in the UK and Europe as it stands right now. Yeah, just want to highlight again, the market is very sensitive to supply shocks, as we've seen this year as well. And again, like last year, extensions to Norwegian maintenances impacted the market again as well. So moving on to the next slide, please. So from the last few slides, I just basically explained what's actually been happening over the last 2 or 3 years. I think I've made it pretty clear, market's very sensitive to any supply shocks. Without Russian gas supply, the market is still prone to spikes. Weather still plays a fundamental role, and Russian gas supply has just really been replaced by our demand for LNG, and we become more susceptible to prices or weather events in Asia. Also want to highlight the fact that, look, as it stands, fundamentally, we are very bearish. Everything looks fine in terms of supply and demand outlook in the UK and Europe, but the geopolitical risks continue to create volatility, and they will continue to create volatility going into the next 6 months or so. So I'm going to talk a little bit about prices today, fundamentals today, and where gas could end up in the winter period. So this chart over here is just basically the curve for both Asia, the UK and Europe. The blue line is a UK price, the orange line is a European gas price, and as you can see, the grey line is the Asian gas price. So despite the decline in prices over the last 2 years, global gas prices remain priced higher than the pre-energy prices. So although the market prices have been on a downward trend, volatile, but on a downward trend, and they're still higher than they were in previous years. Okay, so as it stands right now, we can see that the TTF market or the gas price in Europe is cheaper than where it is compared to the UK, and the Asian gas price is higher than the whole of the European and UK gas curve. So as it stands right now, a lot of the LNG or a lot of the contracts is expected, or most of the gas will go towards the Asian market. So this is just a high level chart to show where prices are right now, and as it stands right now, a lot of the gas will go to the Asian market. Obviously, shipping rates, regasification rates, liquefaction rates, exchange rates, all of these kind of things have to usually be taken into account. But I just want to show high level where we are right now, where the Asian market is at a price premium. And because I mentioned how important LNG is now to the UK market, I just wanted to reiterate that, look, LNG looks like today it's going to go towards Asia. Next slide, please. So some of the current market fundamentals, I mentioned this previously. I mentioned this quite clearly, like bearish fundamentals, these bullish geopolitical risks. So these are the terms I'm using. So bearish fundamentals, bullish geopolitical risks. By bearish fundamentals, I mean the supply and demand in the UK and European market looks comfortable, but we can't take away the risks that the geopolitical risks can create. There's nothing to say that, and there could be sabotage by a Russian firm on any of the European gas assets. Like, for example, in October 2023, we saw a pipeline leak connecting an Estonian and a Finnish pipeline. So what actually happened there was a gas leak was reported, and none of the gas from Finland or Estonia actually impacts or actually comes into the UK or UK market in itself, but it still had a price impact. So when the gas leak was firstly reported, the price rose by 15 to 18%, and all of a sudden there was a concern that, look, Russia has done something to one of the European assets. Okay, slowly, as investigations basically were carried out, they said that gas leak was due to a Chinese ship anchor. An anchor had caused that damage to that gas pipeline. And then when people looked into the issue in a little bit more detail, they realized that Chinese ship had come from a Russian port. So you can't ever rule out any Russian interference in any of the European assets going forward. There's nothing to say that any damage on a Norwegian asset won't occur, because something of that extent could occur, because nobody expected the Russian invasion to occur, or of Ukraine to occur. Nobody expected the Nord Stream 2 pipeline and the Nord Stream 1 pipeline to blow up. So these kind of things that we have to keep taking into account and just understand that these kind of things can happen again. So I just wanted to just highlight that the geopolitical risks still remain currently evident in the market, but from a fundamentals perspective, we have very high storage levels in both the UK and Europe, and we still have significant demand destruction across both the UK and Europe. Demand destruction policies were in place previously by the Europeans, which led to significant demand curtailment, and some of that demand hasn't actually recovered. So we're still seeing significantly lower demand than where gas demand was in previous to the Russian invasion of Ukraine. So storage sites, like I've mentioned, comfortable, demand lower. So it just basically means fundamentally well supplied. The bullish side, or the kind of things that could make prices rise in the coming months or weeks, is basically we're witnessing a lower number of LNG arrivals at UK and European terminals due to higher demand in Asia. So why is demand high in Asia? Because Asia is currently extremely warm. They need that gas for air conditioning, and also because of the fact that coal output in Japan is low at the moment, and they need that gas for power generation. So, and that's not only in Japan, sorry, that's also in South Korea. So we're seeing high demand in Asia, and because of that, Asia is paying a higher price, and because of that, the UK and Europeans are not actually being able to procure any of that LNG. But is that an issue right now? Not really, because we've got high storage levels. We don't really need the LNG right now. We need the LNG in the winter, especially if it gets cold. And if we don't see that LNG in the winter, we could see some volatility in prices. But if the UK prices rise and they start to compete with the Asians for that gas, then we could start seeing more of a dampened effect. So just trying to highlight that, yes, Asian demand is critical now to UK gas and power prices. So I've already mentioned the geopolitical risks with regards to the Russian attacks on Ukraine gas storage facilities, but also the possibility of Europe banning Russian LNG. So Russian pipeline gas towards Europe is pretty much non-existent. We're only getting 40 MCM, which mostly goes towards Austria, but we're still seeing a significant amount of Russian LNG coming into Europe. The countries that are importing that gas are Spain, France, and Belgium mostly. The UK has a ban on Russian LNG, but these countries are still importing Russian LNG. There is a consensus, or the European Commission has indicated that there could be a ban on Russian LNG going forward. But how would that actually impact the market price? It remains to be seen. I think currently Russian LNG accounts for 2 BCM. I'm just trying to think of it in terms of numbers. So if you look at all of the LNG that Europe imports, I think Russian LNG accounts for 16% of that, so which is about 2 BCM. It's not a significant amount, but the reality of it is none of this has been priced in. So if this ban does come across, we will see some upward price movements because none of this has been priced into any of the contracts. And obviously the market remains sensitive to supply shocks. Going forward, please. So just looking in detail into the fundamentals that impact the UK gas market. So like I mentioned, demand destruction is evident, demand is lower, but I'm going to look into a bit more into the supply side of things for the UK on the gas side. As you can see, storage sites are pretty comfortable for this time of the year. They're pretty close to where we were in 2023. Don't think there is any real concern that storage sites won't be close to 100% full going into the winter period. Just one caveat here. Although storage sites look extremely full, the capacity is very low in the UK. So if you think about it, the UK can only hold 7 days worth of winter gas supply or worth of winter gas demand. So if you got extremely cold for 2 or 3, 4 days, this storage, the capacity here would deplete significantly quickly. So that's why when we look at storage sites, we normally look at European storage sites, which I'm going to look into the next slide. But European storage sites is a better indicator of how well the region is doing in terms of gas storage. As you can see, we have to just look at what we have in UK in itself, and it's very comfortable. UK LNG imports, like I've been talking about, are significantly lower year on year. So if you look at the blue line, that's 2024. As you can see, they're significantly lower than previous years, and that's because of the higher Asian demand. If we see a similar picture going forward, then we could start seeing some price volatility in UK gas and power prices going forward. So storage side's comfortable, LNG imports low, and I think we expect them to be low going forward. If the weather remains warm, no real impact. But if we start to see cold weather, especially in Q4, then we will see some spikiness in prices. That's something that is pretty much guaranteed. Norwegian supply to the UK, as I mentioned, this is when the maintenance happens during the summer periods. Yet it still remains robust into the UK. The UK and the UK and Norway have long-term supply contracts, which mean that the UK normally imports a significant amount of Norwegian gas at relatively good prices. Any negative impact on Norwegian supply to the UK is going to significantly impact the market because now the UK relies so significantly on Norwegian supply as a supply source that any trip up, any supply shock here is going to make the market rise. Yeah, because we've seen a 10, 12, 15% supply or price hike during the summer months. It's concerning that what would actually happen in the winter when we need the gas and a Norwegian asset turns off. So just something to highlight that Norwegian supply into the UK is very critical. Moving on to the next slide, please. So UK power, just wanted to quickly show that. Look, right now, as it stands right now, I know we're talking a lot about the gas and how gas prices have done, but UK power, I just wanted to quickly look into the wind generation. Wind generation now accounts for a significant amount of the generation mix, as well as solar production. So as you can see, these two slides there, these two graphs here, and because of that, gas's reliance for power generation is lower. As you can see, the blue line is a bit lower or significantly lower than the previous years. So we're using less gas for CCGT generation in the power generation mix because wind and solar generation is a lot higher. If you look at, a similar picture here, as you can see the blue shaded area on the graph on the right, you can see that the CCGT generation is not as high as it used to be. Overall, UK power market in itself remains illiquid and it's very difficult to get prices, especially further out on the curve. However, it's still prices have been clearing a lot lower on the day ahead compared to prices further out on the curve, and that's because of high wind generation and high solar generation. But still, the market design means that gas still is the primary price driver of UK power prices, which is pretty much a design flaw still. However, I think going forward, I think there needs to be some thinking done here so that there's a bit of a decorrelation between gas prices and power prices because of the increasing influence of wind and solar generation. Moving on to the next slide, please. So temperatures over the last 2 years have largely been above seasonal normal. As you can see, the actuals on both the graphs have been higher, especially during Q1 for both winters compared to the normal. And that's basically been the saving grace for the UK European market. We've not had any real demand during the winter period. And because of that, we've had a comfortable supply outlook. Winter 24, if we do see below seasonal normal temperatures, so if the blue line is below the orange line consistently, then we will see a significant price hike for contracts further out on the curve. So for that, I mean October 24 start dates, October 25 start dates will be impacted in October 24. Just want to quickly allude to one point. So if you look at the graph on the left, during the December 22 period, when temperatures actually went significantly below season normal, that 12-day period that I highlighted in the graph earlier in the webinar, that led to a 20%, 25% price hike. This 12 days worth of cold supply, or 12 days worth of cold temperatures led to a 25% price hike. So if anything happens again this winter, you could expect a similar magnitude going forward, because the reality of it is nothing has changed fundamentally since the Russian invasion of Ukraine. The UK, Europe are not all of a sudden producing any more gas. They're still importing, is just from a different source. Moving forward, please. So just wanted to touch upon the fundamentals in the European market. So I looked at the UK market, looked at gas, just showed that look, it's comfortable from a fundamentals perspective, but the geopolitical risks remain. From a European perspective, I just wanted to show that look, EU annual LNG imports have significantly risen since the Russian invasion of Ukraine. They may be a tad lower this year because of high demand in Asia, but as you can see, it's been on an upward trend. European storage sites are at comfortable levels and significantly higher than the 10-year average. again, this gives us confidence that look, even if it does get a little bit cold during Q4, we should be able to cope. Just the last thing here on the French nuclear production, as you can see, this was a significant driver of prices during August 2022, low French nuclear production. But as you can see, it's picked up in 2024, and that's basically given us a little bit more comfort that look, we can basically get through a winter with us importing or exporting from the French market. French nuclear production accounts for 70% of total electricity production in France. And because it's interconnected to the UK, it has a vital impact on UK power prices. The interconnection has always been there, but the impact of any negative news in France, apart from in 2018, 2019, it wasn't really that existent. So any negative news with French nukes on the UK power price never really made the market move, but now it's something that we have to follow quite closely. Yeah, moving forward, please. So, yep,
Sorry.
Yep. So, I've looked into what's happened previously over the last 3-4 years. What's actually happening now? I've shown that look, fundamentally we are okay. Weather still plays a big impact, or is going to play a big impact going forward, but the geopolitical risks remain. So the kind of thing. Now I'm just going to look into some of the risk factors going forward and what prices could look like in terms of scenarios for the remainder of this year and going forward into 2025 and 2026. So for me, some of the main risk factors going forward are Europe banning Russian LNG. Although this remains with the European Commission, there is consensus that this could happen at some point in 2025. More recently, there's been a ban on European or Russian transshipments in the EU, which basically means normally Russia would ship gas towards Europe, which would then be re-exported. That's been banned as of earlier this week with a transition period of 9 months. So that, yeah, could Europe ban Russian LNG? Maybe at some point, especially if Russia intensifies its stance on or its actions against Ukraine. The escalation of the Israeli-Palestinian conflict, if it continues to impact some of the trading routes or the shipping routes, is still something that is a risk factor going forward, as well as the escalation of the Russian-Ukraine conflict in terms of its drones and missiles activity on assets, energy assets. Can a Russian missile drone sabotage impact any of the Norwegian European assets going forward? There's a possibility. So we've all got to take that into account and remain cautious, because something of that sort could happen, and if that does happen, we could see price spikes of up to 50% and above and beyond. French nuclear production, again, the French nuclear production is a vital price driver for UK power prices. French nuclear production is got government backing from France a lot of the time, because previously what used to happen was they were like, oh, if water temperatures go below a certain degree or go beyond a certain degree, sorry, they said don't use that water for French nuclear production. But now the French government has said, look, even if it goes up to 23, 24 degrees, the river temperature, just use that water, because we need to make sure French nuclear is producing, because we can't have power prices go as high as they did. So there's a different stance by the government on French nuclear production, which basically means that it's less likely to trip up or produce at low levels. But again, the French nuclear fleet is old, and any maintenance or any trip ups there is going to impact UK power prices. Weather is a massive risk factor. We've had 2 warm winters in a row. What's the probability of it being warm again this year? Yeah, it's uncertain. It still remains uncertain. It's something that we can't actually model accurately at the moment. But again, yeah, for me, weather is a big driver of prices, especially given how tight supply is globally and how reliant the UK is on LNG. Just something it's become very much more important than it was previously or over the last 10-15 years. Because previously, if it got cold in the winter, the UK never used to really worry, because it used to have gas in storage sites, in rough storage facility, so it would just withdraw that gas. But we can't withdraw that gas no more, because we don't have that much capacity. So we have to import, and importing means cost, which basically has to be paid by fundamentally the consumer. Asian demand for LNG, there's higher demand so when there's high demand for LNG in Asia, it just basically means a supply gap in the UK and European market. Russian pipeline gas towards Europe is pretty much seized. There's still a transit deal currently is currently in place, which expires in January 2025. The consensus is that that deal is not going to be extended. That could have an impact on price going forward, even though the gas volume is small. It's only 40 MCM, which is about 10% of the volume that it used to produce or send towards Europe historically. But yeah, I think that will drive some volatility going into the latter half of the year. Next slide, please. So short-term scenarios for the remainder of 2024. It's a lot of this I've already mentioned, to be honest. Yeah, for the remainder of 24, the bullish price factors are the market sensitivity to supply shocks, the Ukraine transit news driving volatility during the Q4 period, extensions to Norwegian maintenance assets during this summer, high LNG demand from Asia, most notably China and India, obviously Japan and South Korea as well, the geopolitical tensions, low number of LNG cargo arrivals at UK European terminals, and the cold snap, or the potential of a cold snap. So a lot of these will impact supply mainly, to be honest. Yeah, so these are the bullish factors that could impact the market for the remainder of the year. Some of the bearish factors, we've got good storage levels in both UK and Europe, and that puts us in a good position going into the winter period. So even if we do have a cold snap, we should be able to cope. Demand destruction is still evident, and there's expectation that demand is not going to recover as expected. That's mainly also due to the fact that the economic mood, or this high interest rates, high inflation, and all of those kind of things are impacting demand across the whole of the globe. Nuclear output continues to remain firm in France and continues to recover. European hydropower continues to remain robust. Nuclear production is forecast to be higher this year compared to previous years, as well as solar and wind generation. So fundamentally, yeah, we look comfortable. There's no real threat, but the threat just comes from the geopolitical side of things and from the demand in Asia and weather. So for me, the risk factors are weather, geopolitical risks, and as well as demand in Asia for gas. Moving forward, please. Beyond 2024, there's obviously an increase in energy capacity globally. We're seeing that even in Europe. So we've seen some floating LNG storage units in Germany. So people are starting to recognize how important LNG is. There's obviously increasing renewable capacity. A lot more firms are going towards solar generation and trying to rely less on the grid for its generation. Demand destruction policies, and Europeans shift away from gas due to net zero targets. And because of that, there's a lack of investment in gas infrastructure. So although I've drummed on about how important LNG is for the European and UK market, there's been a massive reluctance by European firms as well as UK suppliers to actually sign long-term contracts, because they're trying to get away from gas as well due to the climate goals that they've put in store. So is a debate between energy security and green energy. So that continues to basically caveat the whole situation. So we need LNG, but we don't want to invest in LNG going forward either. So just something to be aware of. And bullish is the expiry of the Russian-Ukrainian transit deal, Europe banning Russian LNG, damage to energy infrastructure due to geopolitical tensions. A lot of the gas a lot of the energy gas comes from the US, and if Henry Hub prices remain where they are right now, some of the producers will begin to shut down because it's not going to be financially profitable for them to operate. So what will happen in that instance is a lot of the energy prices will start to become a little bit more higher. And obviously there's a potential demand recovery going into 2024 due to improvement in the global macroeconomic picture. Yeah, so if you think about it, fundamentally, again, well supplied. It's just the geopolitical risks that are of real concern going forward. Moving on to the next slide, please. Yep.
Thank you.
That's pretty much it from me, yeah.
Yeah. Brilliant. Thank you very much, Ramnik. I guess just to summarize the points very briefly, are that, energy prices are influenced by lots and lots of factors, all the ones that Ramnik has just went into detail about. Secondly, energy prices are volatile, and the cost can rise and go up or down very quickly, very significantly. And thirdly, no one knows for certain how the prices will develop in the future. So there's obviously a price risk there to be managed. And yeah, that's why it's important to know exactly what's going on. We haven't had that many questions in, so I assume everyone knows, understood what was being said throughout the presentation. What we'll do, I'll ask a question or two now. And if anyone else there thinks of any questions they'd like to ask, please do. Just type it in, and we're going to answer that. We've got a few minutes left. I was just we said obviously that the picture at the minute, Ramnik, is fairly comfortable fundamentally, but the prices over the last few months, they've been moving upwards, you know, as opposed to, because I think they reached the low probably about like March time.
That's right, yep.
And they've been moving up since then. I think if I go back to an earlier slide, we can probably see the move. Yeah, so like they reached the low, and now they've been moving up, despite fundamentally the situation being all right. So what's the driver and the risk there?
So it's mainly geopolitical, to be honest. So any report of any Russian missile strike or any Ukrainian missile strike on any of the Russian assets and Ukrainian assets is basically driving the market upwards, to be honest. And obviously we see Norwegian maintenance as well, or extensions to any Norwegian maintenance. And because of that, yeah, because we've seen extensions to Norwegian maintenance on assets, the market is basically just being concerned that, look, can storage sites be filled up in time? So there's just that sort of risk that's being priced in. And some of that risk may be unwarranted, especially if we see a warm winter.
Yeah.
However, the reality of it is prices or contracts are starting to, they're going to build excessive risk premiums based on the fact that, look, can we cope with the winter going forward?
Yeah. Thank you. And obviously we're looking at the winter 24 periods on this chart here. I assume it's a similar picture, longer dated prices, the winter 25 following the same kind of curve.
Absolutely, yes.
Yeah.
So the curve is currently in backwardation, but it's still following a similar trend. So winter 24, if it rises, so is winter 25, so is winter 26. And same as summer 25, and summer 25 is rising, so is summer 26, and so is summer 27. But obviously the curve is in backwardation, so it is cheaper to buy contracts further out the curve than it is currently right now.
Thank you. And the other thing which I was wondering about, I mean, please feel free to chip in any questions, anybody. Someone's asked if there's going to be a recording available, and yeah, there will be. We will make a recording of the session available afterwards. But if anyone has any other questions, please ask. The other thing I wanted to ask, the Russian gas that we were speaking about, on a global kind of picture, is Russia still producing the same levels of gas? I mean, globally, is their gas just going elsewhere, and is that displacing gas that, you know, that would have been
Russian gas
anyway, production net off?
Generally has declined.
Right.
They're obviously not doing as well financially since it's cut off its links with the European market. But some of its gas is going towards like India and China and other countries in that region. So yeah, obviously they financially have been hurt by what's happened with the European markets disconnect. But yeah, it's still, and they're producing significantly less gas as well.
Excellent. When are the prices going to be at the lowest, Ramnik? That's a joke question. You can't answer that one. Yeah.
I was going to say we probably missed that. Now it's probably in March 24. The thing is, look, going into the winter period, there's only going to be a little bit more volatility. Like if you look at my view is pretty clear. I think the market is tight without Russian gas supply into Europe. And when I mean the market, I mean the UK and European market. Relying on LNG is always going to create more volatility. We just changed source, and the source that we've changed from Russian gas to Asian or LNG now just basically means that the LNG market's always very volatile because there's so many people wanting to buy it. Yeah. So for me, I think we've probably missed the lows. It's just more upside than downside in my view.
Yeah. Okay. Understood. Last chance for any questions. Don't worry if you think of any questions afterwards. You know, feel free to. Oh, wait there. I think maybe I was looking at the wrong bit. We have questions. Sorry, Ramnik. This is.
Go for it.
Okay. Can you explain what Norwegian? I'll have to do them fairly quickly, Ramnik, because we've only got 4 minutes left. Can you explain what Norwegian maintenance means?
So Norwegian maintenance. So normally, Norwegian supply accounts for a vast amount of the UK gas supply. So Norwegian maintenance basically means their assets go under maintenance during the summer period. So it's just basically their assets basically being serviced again.
Yeah, just to make sure when they're needed, they don't break down. They're operational.
Exactly.
Yeah.
Exactly. And the thing is that the Norwegians, they want to make sure that their assets are operating during the winter periods because obviously prices are higher. So they want to basically make sure during the summer that when prices are lower, they're basically operational.
Excellent, thank you. Another question, does anyone know the forecasted impact of decarbonisation in the UK on the demand for gas, or will that be offset by the need for gas to meet the increased electrical demand?
I'll have to look into that question, to be honest. I will get back to you. Yeah.
Super, thank you. Another question, since the UK since the UK, you can see the question too.
Yeah, so since the UK decommissioned,
I'm still going to read it for the
storage,
benefit of other people. Let me have another go at it. Since the UK decommissioned rough storage, are there plans to recommission to increase long-term supply?
So they decommissioned rough storage facility, then they increased the supply. I think it was about 18 months ago by 3 days worth of winter gas. So they partially reopened it. Will they open it to increase gas supply further? Yet remains to be seen. I think if we see a cold winter and prices spike again towards 200 pence per therm, I think there might be a bit more pressure for them to reopen the remainder of it. But as it stands right now, I think they're pretty happy just to keep it where it is.
Didn't they close it down because of, like well integrity? It was leaking, wasn't it? So I think if you put more gas in there, greater pressure, it'll leak again. Does that kind of put a cap on how much more they can expand it?
Yeah, they wanted to create a hydrogen facility there.
Yeah, that wouldn't work, would it? Hydrogen's a lot smaller than it.
Yeah, so they wanted to basically become. Obviously, there was a consensus in the UK market that we want to shift away from gas, right?
Yeah.
But then obviously, since the last few years, it's just been more about energy security more than anything. Yeah.
Thank you. And the last one's just popped in. Given the volatility, what would be the ideal term to secure contracts for?
So for me, like I've got a bullish view on the markets going forward. If you look at the curve in itself, it's in something called backwardation. So prices further out on the curve, like for example on the gas and power, are around 70 quid or 70 pence per therm. So for me, when prices have been as high as 400 or 500 pence per therm, 70 pence per therm is significantly cheaper. So for me, I would go for a 3-year contract and buy some volumes at least at these prices, because if we have a cold winter, I can easily see 40% upside in some of these contract values.
Thank you. I would just probably say I think the answer there, Ramnik, that you're given, it kind of applies to people who are operating flexible strategies, not people who are operating fixed strategies. Because with the flexible one, obviously, once you have the contract, you can start managing the positions, hedge some, take some risk off the table. If you operate in a fixed strategy, you've got 1 shot at it, basically.
I'd probably say 2 years, to be honest. 2 years, yeah. I wouldn't go too much beyond, because of course, if we have another warm winter, then prices will go lower again.
Yeah.
If we have a cold winter, then obviously prices could see 40-50%. So it's just all weather driven, which we don't know. So yeah.
Super. Thank you, Ramnik. Yeah, I guess it just it's difficult to know for certain, but yeah, if you've got a flexible contract, I think you've got a different way of managing the risk than what you're doing. You're doing a fixed approach. Excellent. Well, that's pretty much it. The time that we have is just turned 12 o'clock. So thank you everyone for joining. We do have another session next Tuesday about the procurement strategy, the ways you can actually buy the energy to mitigate the risk. So maybe answering that last question in a bit more detail, going into the different options. And then we're going to do the third one the week after. So I hope I hope all of you will be able to join that one as well. Like I said, the recording will be available. Thank you all for your time. Hope you all have a good day. Thank you.
Thank you, guys.